So we love the monopoly stock exchanges. For example, the Chicago Mercantile Exchange, Deutsche Börse, the Hong Kong Stock Exchange, and the Japanese Stock Exchange. If I can use the Chicago Mercantile Exchange, and if I can abbreviate with CME. So CME has three main businesses. One, they do futures contracts, which is effectively just volumes on oil price. Two, they do futures, again, volumes on interest rates. And then three, they do volumes on volatility. So when you sit back here, you go, okay, volatility in the market at the moment is at all-time lows. Why is it at all-time lows? Because the Fed is keeping interest rates low and is not changing their balance sheet. So as a result, when volatility is low, then their volumes collapse. If you look at interest rates are at near all-time lows. So again, what does that mean for their business? It means their volumes for the interest rate products collapse. And then if I go back to the oil business has been bouncing around as oil price has averaged that $50 oil price for a while. So as an owner or a common sense business person, we sit back here and we go, it's a monopoly asset, which we know, or which means it has pricing power longer term. They have a management team that is focused on getting costs out of the business because they do not know when the volumes in their interest rate products and their volatility products are going to ramp back up. And then at the same time, the management team is saying, because we're in a bit of a trough with our volumes, all of the free cash flow will be coming back to you as the owner via a nice dividend yield. So we sit back here and we say, as long-term owners, one day interest rates will go up, one day volatility will increase, but we're getting paid to wait with a nice dividend yield to wait for these occurrences to happen. And we know that because it's a monopoly, that when volumes do come back, they'll have pricing power, which will then be able to flow through to us as share owners of the business. We take a common sense business person's approach to buying assets. We value the assets like a private equity manager would. So yes, we are contrarian as our businesses are depressed when we're buying them, but we focus on unique quality assets that produce solid free cash flow and have management's interests aligned. We complement the other fund managers well because we are so different.